All right, let's kickstart the first conversation of the day, and that has to do with investing abroad, specifically investing in equities abroad. Santosh Navlani, the Chief Operating Officer of ET Money, is joining in. Santosh, thanks as always for taking the time. Now, we're speaking at a time when in the US particularly, you've seen a bit of a downturn. You've seen the NASDAQ drop quite significantly. Tech stocks, as is their wont when interest rates go up, have fallen quite dramatically. The question is, does the thesis still hold true? Where the last couple of years particularly, we were talking about for the need of diversification, an Indian investor can look at investing in equities abroad, a certain portion. Does that thesis still hold?
Hi, Alex. Yes, definitely. The events which we are witnessing right now, right from February when the Russia-Ukraine war started, and markets have been very volatile since then, or the inflation readings which are coming across different global markets and economies where lifetime high inflation is being witnessed, or a multi-decadal high inflation being witnessed. These are cycles of the economies which will always be there. It should not affect the long-term investment plans or the investment thesis that we are always recommending to our investors, where you need to diversify across multiple asset classes, which means equity, debt, gold, real estate. Within equities, you diversify within your domestic equities as well as international equities. That still holds true. This kind of drawdown or this kind of correction which you're witnessing in the marketplace should not change any kind of plans that people have.
Absolutely. Okay. But speak about some of the reasons why somebody should consider looking at international equities. It's beyond just the overarching idea of portfolio diversification, right? And how much on an average, and of course, this is depending on an individual's risk profile and risk-taking ability, but what are the strictures that you think people should put on themselves?
Yeah, so Alex, I know there are multiple reasons. We always talk about portfolio diversification as one of the key aspects which international equities can bring into your equity portfolio. But then I think we can probably delve deeper into that aspect alone and understand that a lot of companies that we are consumers of in India, be it online products like Google, Facebook, or WhatsApp, Instagram, Amazon, Netflix, I can go on and on, even physical goods companies which are there in India where we consume a lot of them, even pharma names, we consume a lot of products. A lot of these companies are not available for investments on Indian stock market to us as retail investors. So you don't have an option if you're somebody who believe in the growth story of these companies, which are global MNCs and derive a lot of their portion not just from India, but also a large part of Asia and Asia Pacific and Europe and other markets as well. So it just is so kind of commonsensical and logical to take some exposure in these companies whom you can't live your day without today. So that's number one reason, apart from portfolio diversification. The importance of these consumer names into our lives is what motivates all of us to become have a kind of piece of the pie that they are growing their revenues and profits from. Second aspect, which sometimes gets completely missed out, that when you invest internationally and diversify your portfolio, you not only diversify into the economic risk that your country or other countries are going to go through, but you also basically hedge your currency or exchange rate for that matter. So India, being a developing economy, has always kind of seen a depreciation of its exchange rate against the US dollar over long periods of time. And even right now, as we are kind of talking, Indian rupees actually has been historically the lowest against US dollar in the last few days. And that just shows one reason that you should be basically having some portion of investments into currency beyond Indian rupee, where the depreciation of rupee may add to your portfolio gains. And many people today travel abroad. Sometimes people also plan their children's education abroad. And when you send your children abroad for studies, which may have a long-term implication of finances and actually can kind of cause some kind of spend for a sustained period of time of couple of years, and a large sum is required. At that point of time, if you really kind of have some amount of money in the currency of the country that you are sending your kid to, you may actually benefit a lot from the currency depreciation of their domestic counterpart of India in that sense. So if you are looking at kind of planning your children's education abroad, especially in US market, it just makes sense to really have some kind of your investments into US kind of currency in that sense. And one of the ways to do that is actually buy an Indian mutual fund which is actually investing into international markets, including US, and maybe other ways to do it directly by buying US stocks as well. So I think the case for international investing remains as strong as it's always been. And I wouldn't really say that this kind of market situation that we witness today has anything to do with changing that stance.
So we've established the thesis and we've said that it definitely does make sense. Let's talk about the vehicle then, because that I think is the most pertinent point right now, because not all routes are currently available. So first, can you explain what the current context is and what the available routes are, Santosh?
Yeah, so I would like to focus on the mutual funds or more organized way of investing into international markets than investing directly, because we believe that even investing kind of in Indian market requires some kind of expertise for your long-term investments as an individual investor, and investing in foreign markets may require you much more understanding of those markets, which is not possibly available to common investors like you and me. It is far more beneficial to rely on a fund manager, which is through mutual funds route available in the country today. And there are primarily 3-4 ways that mutual fund companies operate international funds. The simplest way is basically a fund manager sitting in India actually manages the portfolio actively by investing or buying stocks of the different global markets. So take, for example, there is ICICI US Blue Chip Equity Fund, or a Nippon US Equity Opportunities Fund, or maybe a Franklin Templeton US Fund and things like that. So most of these funds actually buy US stocks on their own sitting out of India. And that route kind of actually is like an actively managed route of buying US equities. The second route available is where an Indian fund manager actually is managing the money passively by investing, for example, in a NASDAQ 100 index or S&P 500 index. And now even that route is possibly closed today because the fund managers in India were not actually buying an index fund of S&P 500 in US, but they were actually buying these stocks on their own into the weights which are actually governed by S&P 500. So I would actually buy an Amazon or a Facebook or a Microsoft or Apple in the same proportion as their weight in S&P 500 index, but I will be managing directly buying from here. The third route is which is available is where you actually buy a domestic equity fund, which allocates a significant proportion of one's investments into international stocks. So there is Parag Parikh Flexi Cap Fund. One of the funds by SBI is there. There is DSP Value Fund, which is a value theme fund for India and global markets. So these funds actually allocate up to 35% of their monies into international stocks, and rest of the money goes into Indian equities. And one of the best ways probably to buy a Flexi Cap Fund, where you actually get a global equity portfolio where your international allocation is limited to 35% and rest is in equities. And the fourth route actually is a fund of fund structure, where an Indian fund manager actually buys or routes the entire money very, very passively directly into a US fund. It can be like a global innovation fund, which a DSP mutual fund has. There is another Birla Global Excellence Fund. There is also Global Emerging Fund they run, which actually buys one of the directly fund in the US, and that fund basically manages the money indirectly for you. So even that route is available, and within that route, people actually also buy ETFs directly. So one of the a fund operated by Mirai actually buys a Nasdaq. No, no, not a Nasdaq. It's like it's called FANG Plus ETF. They buy directly, and there is a new fund being launched or just launched by Navi Mutual Fund, which is a fund of fund into Vanguard's total US market fund. So there are multiple ways to buy. I think all the routes are actually closed except the fund of fund structure, where there are three or four handful funds available right now, and most of them actually are thematic funds. Like there's a DSP Global Innovation Fund, which is very thematic, focus on innovation as an idea. There is another one by Aditya Birla and maybe a Kotak, where they're buying a Nasdaq index in US, and it's a fund of fund. Nasdaq again becomes a very very thematic investing theme in our opinion, where a lot of your money is going into technology stocks, and may not be the best way to buy your long-term portfolio. There is in the absence of an S&P 500 index fund, which is operated by Motilal Oswal, the Navi Mutual Fund's Vanguard a total US market fund is a good, excellent idea in our opinion, where you almost buy the entire US market, almost 4,000 odd stocks, where 25 odd stocks contribute about 10% of the weightage. And one can actually buy that fund for long-term investments as well. So that route is open. Only probably one fund is for worthy of buying for long-term investments is how I would look at. And once the relaxation comes into picture by RBI and SEBI's understanding is possible from that side for the industry, these routes will all open up, and I'm sure people will have a lot of options to choose their long-term investments for international diversification.
I take a point on the NASDAQ, and I don't want to argue on the other side as well, because there are statements that have been made. There are people that have spoken about the fact that a 30% downturn in the NASDAQ since the start of the year is a good opportunity to chip in, to have some kind of allocation, because this is, after all, an index that has the largest of large companies. The biggest global companies are the likes of Alphabet, the likes of Amazon, and these are tech companies, of course. But going back to a conversation, I think, Santosh, that we've had in the past about thematic funds, about sector funds, do you think that this applies? And you've said effectively that, but if somebody knows what they're getting into and they take the fund of fund routes to invest in this, is that still something that they can consider?
So, Alex, there is never a one size fits all approach in investments. To each his own is how I would say that. Nasdaq remains a tech heavy index. It's not a sector fund, because there are technology companies of various sectors, not just from digital products and digital advertising or hardcore technology, consumer technology products, but there are also services companies, healthcare companies, even like an automobile company like Tesla in that sense come into picture. So it's not a tech fund. It's a thematic category on, I would say, world's largest or leading technology companies, or other companies which are using technologies to build competitive moats. So it's a great way to invest. But if you are somebody who's investing into international markets, you cannot be relying only on technology innovation as a way to invest. So if you believe that NASDAQ is the best way to invest, nobody contests that, just that you should not be putting all your money only into NASDAQ. Diversify with a diversified approach to investing, like a US S&P 500 kind of index fund, or some kind of actively managed US fund or international fund, or maybe even a Navi Mutual Fund's total US market fund. That gives you at least opportunity to invest beyond technology and diversify your risk. So in investments, controlling risk, managing risk is equally important than just return chasing. So I would say that if you are somebody who believes in technology as a way to invest for life, then allocate a large portion to NASDAQ or a technology kind of innovation fund, but ensure that you have some amount of money also in other sectors or a diversified actively managed or a passively managed fund. On the point of NASDAQ, where sometimes people do get carried away of the recent returns or last decadal returns, one should not forget that NASDAQ actually touched its high first time in sometime in 2000 during .com boom. as I would call it, around 4,000 odd levels or 4,600 odd levels. And then after the bust, it took 16 years to reclaim that value. So while we are looking at Nasdaq as a really great return in last decade and more, we should not forget that Nasdaq also had 15 years of no return. And when the global policy making gets changed, because US and US central bank Fed controls a lot of how other markets behave, when the regime change is happening, where one is actually going from extremely low interest rate policy regime to like maybe tightening the economy and interest rates further, you never know how the different sectors to the market react. So putting your all money in one kind of thematic category like Nasdaq, it's better to actually diversify and put into multiple things. And maybe if you are wanting Nasdaq as a primary thing, have it as a primary, but allocate some portion of money into non-Nasdaq as well.
Very well explained, I think. And there's one more point that I want you to speak about, Santosh, very quickly, is the taxation of these international funds. Could you very quickly explain what the rules are that govern the taxation element?
Sure. So to make it quick, it's Indian regulations are such that you get equity tax treatment when the fund is actually investing up to 65%, or rather minimum 65% in Indian equities, and if up to 35% being international and rest being in domestic equities qualifies for equity taxation. So a Parag Parikh Flexi Cap fund, for example, which has this kind of structure, you get an Indian equity taxation treatment where 15% of your gains are taxed. 15% is a tax you pay on your short-term capital gains, and the long-term is applied after that. But if you are investing fully into a fund of fund or an actively managed US fund, then the entire portion goes outside of India, which means that you actually qualify for a debt taxation structure, which is basically if you sell your holdings before finishing 3 years into the investment, you would be liable for a taxation which is as per your marginal tax rate, which is 30%, 20%, 10% as per your income tax bracket. And if you sell after 3 years of holding the investment, then you qualify for a long-term capital gains for debt taxation, which is 20% tax on the indexed price of purchase price. So it's pretty simple. The way you look at equity and debt mutual funds is how you should look at the international funds when you're purely investing into a full international fund as that taxation structure.
Thank you so much, Santosh, for breaking all of that down for us. Pleasure speaking with you as always, and I look forward to our next chat.